Before we begin today's analysis, a brief word. If you value thoughtful, measured insights into precious metals and financial markets, analysis that prioritizes discipline over drama, consider subscribing to this channel. Look for the red subscribe button below this video. We're building a community of serious investors who understand that wealth is built through patience, not panic. Your subscription supports independent financial education that respects your intelligence. Now, let's examine something extraordinary happening in the silver market. Something unusual is unfolding in the silver futures market. 31,828 contracts, a single position, held in what traders are calling a frozen market condition. To understand why this matters, you need to grasp one fundamental truth. Each silver futures contract represents 5,000 ounces of physical metal. We're talking about approximately 159 million ounces of silver tied up in one concentrated position. That's not just large, that's approximately 20% of annual global mine production held in a single futures position. Why does this concentration exist? Who benefits from it? And most importantly, what does this mean for you as an investor or potential investor in precious metals? Today, we're going beyond headlines. We're examining the structural mechanics of commodity markets, the historical patterns of price suppression, and the specific circumstances that make this situation noteworthy. This isn't about conspiracy theories. This is about understanding how concentrated positions influence price discovery, how regulatory frameworks sometimes fail to prevent market distortions, and how you can position yourself intelligently regardless of manipulation claims. Whether you currently hold silver or you're considering an entry point, the next 20 minutes will equip you with framework, context, and actionable strategy. Let's begin with clarity. What exactly are we looking at when we reference 31,828 contracts? The silver futures market operates through standardized contracts traded on exchanges like COMEX. Each contract is an agreement to buy or sell 5,000 ounces of silver at a specified future date and price. Traders and institutions use these contracts for two primary purposes: hedging against price risk and speculating on price movements. Here's where it gets interesting. When one entity or coordinated group holds an exceptionally large position, particularly on the short side, they gain significant influence over price direction. This isn't theoretical, it's mathematical. If you're short tens of thousands of contracts, you profit when prices fall. You have a direct financial incentive to suppress upward price movements. Now combine this with a frozen market condition. What does frozen mean in this context? It refers to a market state where liquidity becomes constrained, where the bid-ask spread widens, and where normal price discovery mechanisms become impaired. In simple terms, fewer buyers and sellers are actively trading, which means larger positions can move prices more dramatically with less capital. Think of it like this. In a highly liquid market, your actions are like throwing a pebble into an ocean, barely a ripple. In an illiquid, frozen market, that same action is like throwing a stone into a shallow pond. The ripples are significant and lasting. When 31,228 short contracts exist in such conditions, the holder of that position has disproportionate influence. They can suppress rallies simply by existing. The mere presence of that short position acts as a ceiling because traders know that any upward price movement will eventually face selling pressure from someone who needs to either maintain or exit that massive short. This is the mechanics. Now let's discuss the history. Claims of silver market manipulation are not new. In fact, they extend back decades with documented cases, regulatory settlements, and ongoing scrutiny from market observers. Let's establish some historical markers. In the 1970s, the Hunt brothers famously attempted to corner the silver market, driving prices from around $6 per ounce to nearly $50 before the scheme collapsed. Regulatory changes followed, designed to prevent such concentrated positions. Fast forward to the 2000s and 2010s. Multiple major banks, including JP Morgan Chase, HSBC, Deutsche Bank, and others, faced investigations and ultimately settled cases related to precious metals manipulation. These weren't fringe accusations. These were regulatory findings that resulted in hundreds of millions of dollars in fines. In 2020, JP Morgan paid $920 million to settle spoofing charges related to precious metals markets. Spoofing involves placing false orders to manipulate prices, a form of market manipulation that's explicitly illegal. Why does this history matter for our current situation? Because it establishes pattern and precedent. The silver market has been subject to documented manipulation multiple times. The regulatory framework exists specifically because these behaviors have occurred repeatedly. When we see unusual concentration, like 31,128 contracts in illiquid conditions, we're not engaging in speculation. We're pattern recognition based on documented history. Now, let's address the elephant in the room. Why would entities manipulate silver prices downward? The motivations are multifaceted. Large commercial banks often hold short positions as hedges against their physical holdings or client obligations. But there's another dimension. Silver, like gold, serves as a monetary alternative and an inflation hedge. When precious metals prices rise significantly, they send a signal about currency stability and inflation expectations. Central banks and large financial institutions have a vested interest in maintaining confidence in fiat currency systems. Suppressed precious metals prices help maintain that confidence. This isn't conspiracy, it's institutional incentive structure. Does this mean every large short position is manipulative? No. Legitimate hedging exists. But when positions reach extreme concentration in illiquid conditions, the line between hedging and manipulation becomes blurred. The question isn't whether manipulation is theoretically possible. History confirms it is. The question is whether current market conditions suggest it's happening now. Let's examine the evidence. What makes the 31,128 contract position particularly noteworthy? First, timing. This concentration has emerged during a period when physical silver demand has been exceptionally strong. Industrial demand, particularly from solar panel manufacturing and electronic applications, continues growing steadily. Simultaneously, investment demand has surged. Retail investors have purchased physical silver coins and bars at near record levels over the past 2 years, so we have robust fundamental demand, yet futures market prices have remained relatively suppressed compared to historical inflation-adjusted levels. That disconnect between physical demand and futures pricing is itself a red flag. Second, the regulatory position limits that theoretically exist to prevent such concentration. The Commodity Futures Trading Commission, the CFTC, has position limit rules designed to prevent exactly this type of market dominance. Yet this position exists. Either it falls within technical exemptions, or it represents regulatory failure. Neither explanation is particularly reassuring for market integrity. Third, the behavior of the basis, the difference between futures prices and spot physical prices. In normally functioning markets, this basis remains relatively stable and predictable. When manipulation occurs, the basis becomes distorted. We're currently seeing periods where physical silver trades at significant premiums to futures prices. That's backwards from how these markets should function. And when physical metal is harder to obtain than paper contracts suggest it should be, you're looking at a market where paper pricing has disconnected from physical reality. Fourth, the open interest data and the concentration among a small number of traders. According to publicly available CFTC data, a tiny percentage of traders hold disproportionate percentages of total open interest. This concentration has actually increased during periods when it should theoretically decrease as markets mature and liquidity improves. What does all this technical analysis mean practically? It means the current silver market structure contains significant distortions. Whether you label this manipulation or simply market dysfunction, the effect is the same. Prices don't accurately reflect supply and demand fundamentals. For you as an investor, this creates both risk and opportunity. The risk, prices could remain suppressed longer than fundamentals suggest they should. You could be correct about silver's value, but still experience extended periods of price stagnation. The opportunity, if and when these structural distortions correct, either through forced position liquidation, regulatory intervention, or overwhelming physical demand, the price adjustment could be substantial and rapid. Your strategy must account for both possibilities. Let's shift from mechanics to psychology. Understanding manipulation is useful. Understanding how manipulation affects investor behavior is essential. When markets are suppressed, a specific psychological pattern emerges among participants. First, retail investors become frustrated and capitulate. They entered positions expecting fundamentals to drive prices higher. When prices remain flat or decline, despite strong fundamentals, they assume they were wrong and sell, often at or near bottoms. This is exactly what manipulation seeks to achieve. Shake out weak hands before the eventual price rise. Second, momentum traders and technical analysts become confused. Their indicators and patterns stop working reliably because the underlying price action is being artificially constrained. They either avoid the market entirely or get repeatedly stopped out by volatility designed to trigger their predetermined exit points. Third, sophisticated longer-term investors recognize the distortion and accumulate positions. They understand that manipulated markets create asymmetric opportunity. When prices are artificially suppressed, risk-reward ratios become exceptionally favorable for patient capital. Which category describes you? The frustrated retail investor who sells when things don't move according to your timeline? The confused technical trader who abandons a market because your systems aren't generating reliable signals? Or the patient accumulator who recognizes structural mispricing? Your answer to that question will largely determine your outcomes in precious metals. Here's the critical insight. Manipulation works precisely because most investors lack the psychological fortitude to maintain positions through extended suppression periods. If everyone could hold through manipulation, manipulation would fail. It works because it's psychologically difficult. The entity holding 31,828 short contracts is counting on investor impatience. They're counting on fear, frustration, and capitulation. Your competitive advantage isn't superior analysis, it's superior temperament. Can you remain calm and committed to a thesis while prices move against it in the short term? Can you add to positions when your current holdings are showing losses? Can you ignore daily price volatility and focus on structural drivers? If the answer is yes, you have the psychological profile to potentially benefit from manipulated markets. If the answer is no, you need to either build that capacity or avoid markets, subject to manipulation entirely. There's no shame in self-awareness. Not every market is suitable for every investor. But understand this. The greatest transfers of wealth happen when patient capital accumulates assets that impatient capital is forced to sell at distressed prices. Manipulation creates exactly these conditions, deliberately. If you currently hold physical silver or silver-related investments, here's your strategic framework. First, reassess your thesis. Why did you originally invest in silver? If your answer was short-term price speculation or momentum trading, the current environment argues for reassessment or exit. Manipulated markets are inhospitable to short-term speculation. If your answer was long-term wealth preservation, inflation hedging, or monetary insurance, then current conditions don't invalidate your thesis. They potentially strengthen it. The existence of manipulation suggests that powerful interests view silver as threatening to their interests. That's actually a validation of silver's monetary significance. Second, evaluate your position sizing and liquidity needs. Do you have sufficient liquid assets and other holdings to weather extended periods where your silver position remains stagnant or declines? Manipulation can persist longer than seems rational. If your silver position is creating financial stress or forcing you to liquidate at inopportune times, your position size is too large regardless of manipulation. The correct position size allows you to hold indefinitely without stress, not just months, years if necessary. Third, consider the physical versus paper distinction. If you hold paper silver through ETFs or futures contracts, you're exposed to the very manipulation mechanisms we've discussed. Your holdings exist within the system designed to suppress prices. Physical metal in your possession cannot be manipulated away. It can't be defaulted on, rehypothecated, or subject to counterparty failure. This doesn't mean paper silver has no role. It offers liquidity and convenience that physical metal doesn't. But understand the trade-offs. In a scenario where manipulation fails suddenly, whether through forced short covering, physical supply shortage, or regulatory intervention, physical holders will likely benefit more directly than paper holders. Fourth, resist the temptation to leverage or concentrate excessively. When investors become convinced manipulation is occurring and will eventually fail, they're tempted to maximize their position through margin, options, or excessive concentration. This is precisely wrong. If you're correct that manipulation exists, you're also acknowledging that short-term price action is unpredictable and potentially adverse. Leverage and concentration amplify vulnerability to exactly those short-term moves. The winning strategy in manipulated markets is unleveraged, patient accumulation, not aggressive, concentrated betting. Fifth, develop specific price levels where you would add to positions. If prices decline further due to continued suppression, would you buy more? At what levels? Having predetermined addition points removes emotion from future decisions. You're not reacting, you're executing a plan. Conversely, define your exit criteria. Under what conditions would you conclude your thesis was wrong? Is there a price level, a time horizon, or a fundamental change that would invalidate your reasons for holding? Without clear exit criteria, you're hoping rather than investing. Finally, ignore daily volatility entirely. If your thesis is based on structural long-term factors, physical supply constraints, monetary system fragility, industrial demand growth, then daily or weekly price movements are noise. Checking prices daily trains your brain to react emotionally to irrelevant information. Consider reviewing your silver position quarterly at most. This frequency allows you to assess meaningful developments without becoming psychologically reactive to manipulation-induced volatility. Your edge as a retail investor isn't information. Institutions have better information. Your edge is patience and lack of career risk. Use that edge. If you're considering entering the silver market, current conditions present a nuanced opportunity. Let's be direct. You're potentially entering a manipulated market. That's not a reason to avoid it, but it shapes your strategy. First, abandon any notion of quick profits or predictable timing. The manipulation we've discussed means that fundamentals might not translate to price appreciation for extended periods. Your entry point could show losses for months or years before eventual appreciation. If that timeline is unacceptable, silver is not your market right now. Second, use a systematic accumulation approach rather than a lump sum entry. Dollar cost averaging or value averaging strategies allow you to build positions gradually at varying price points. This approach reduces timing risk and allows you to benefit if manipulation pushes prices lower after your initial entry. Decide on a total allocation, say 5 to 10% of your investable assets, and deploy that capital over 6 to 12 months rather than immediately. Third, prioritize physical metal for at least a portion of your allocation. Yes, physical silver has storage costs, liquidity challenges, and premium markups, but it also has certainty that paper alternatives lack. Consider a barbell approach. Hold physical metal for long-term core positions, and use more liquid paper alternatives for smaller, potentially tradable positions. Fourth, educate yourself on the broader precious metals market ecosystem. Silver doesn't move in isolation. It correlates with gold, responds to real interest rates, reacts to currency movements, and follows industrial commodity trends. Understanding these relationships helps you contextualize price movements and avoid misinterpreting manipulation as fundamental change. Fifth, prepare psychologically for the reality of suppressed markets. You will likely experience periods of significant frustration. Prices may move contrary to seemingly obvious fundamentals. News that should be bullish might coincide with price declines. This is the nature of manipulated markets. Your ability to persist through these psychological tests determines your success. Consider writing down your investment thesis, why you believe silver has value, what outcomes you're preparing for, what percentage of your wealth you're comfortable allocating. Review this document when you're tempted to make emotional decisions. It serves as your anchor. Sixth, understand the catalyst question. What would cause the manipulation to fail? What would force the short position to cover? What would overwhelm the suppression mechanisms? Potential catalysts include physical supply shortages that break the paper market's credibility, regulatory enforcement actions, inflation acceleration that drives overwhelming investment demand, or geopolitical events that disrupt normal market functioning. None of these can be predicted with timing precision, but recognizing them helps you understand what you're waiting for. Seventh, consider your tax situation and holding structure. Physical precious metals held in certain forms may have different tax treatment than paper securities. Consult with qualified tax advisors about whether IRAs, trusts, or other structures make sense for your situation. Tax efficiency matters over long holding periods. Eighth, maintain overall portfolio balance. Silver should be one component of a diversified strategy, not your entire portfolio. Even if you're highly convicted about silver's long-term prospects, concentration creates unnecessary risk. Other assets in your portfolio will perform better during periods when silver remains suppressed. That balance prevents psychological decision-making driven by portfolio stress. Finally, accept that you might be early or wrong. Even thoughtful analysis can misjudge situations. Manipulation might persist indefinitely. Fundamentals you believe are bullish might not matter to price discovery. Investing always involves uncertainty. Enter positions with humility and appropriate position sizing. Your goal isn't to maximize gains if you're right. It's to remain solvent and psychologically stable if you're wrong or early. Let's be explicit about behaviors that destroy capital in situations like this. First, avoid emotional trading based on daily price movements. Manipulation creates volatility designed to trigger emotional responses. Sharp drops make you want to sell. Sharp rallies make you want to buy more. Both impulses usually occur at exactly the wrong moments. Emotional trading guarantees suboptimal results. Remove emotion by creating and following systematic rules. Second, don't use leverage or margin in manipulated markets. Leverage amplifies both gains and losses, but in suppressed markets, it primarily amplifies your vulnerability to forced liquidation. The entity holding 31,828 short contracts can likely push prices to levels that trigger margin calls for leverage longs. That's often the point of manipulation: force weak hands to cover at a loss. Stay unleveraged. It might feel like you're leaving money on the table, but you're actually preserving capital. Third, avoid concentrating your entire portfolio in precious metals. Yes, silver may be manipulated. Yes, it may eventually appreciate significantly. But concentration in any single asset or thesis creates catastrophic risk if you're wrong, or if timing extends beyond your capacity to wait. Portfolio theory exists for good reasons. Honor it. Fourth, don't fall for social media hype cycles. Silver markets periodically experience waves of retail enthusiasm driven by online communities. These movements often end badly for latecomers who buy at temporary peaks. Make decisions based on your own analysis and financial situation, not social momentum. Fifth, resist the temptation to trade based on manipulation narrative rather than price action. Some investors become so focused on manipulation theories that they ignore actual market developments. They hold through legitimate fundamental deterioration because they're convinced manipulation will end. Be willing to adjust if evidence suggests your thesis is wrong. Sixth, don't ignore counterarguments and alternative explanations. Perhaps large short positions exist for legitimate hedging reasons. Perhaps silver's price reflects actual supply-demand equilibrium better than manipulation theorists suggest. Strong convictions should be held with intellectual humility. Seventh, avoid letting silver positions create financial stress. If worrying about your silver holdings keeps you awake at night, if checking prices causes anxiety, if you're arguing with family members about your allocation, your position is too large. Financial assets should serve your life, not dominate it. Reduce positions to sizes that allow psychological peace. Eighth, don't assume manipulation failure is imminent. Just because manipulation has existed doesn't mean it's about to end. Hope is not a strategy. Time horizons matter. Position yourself to wait as long as necessary. So where does this leave us? 31,828 contracts in a frozen market. Documented history of manipulation, strong physical demand, structural price distortions. This isn't a simple situation with obvious answers. But here's what we can say with confidence. The silver market contains inefficiencies and distortions. These create risk for the unprepared and opportunity for the patient. Your task isn't to predict when manipulation ends. Your task is to position yourself intelligently given the reality that it exists. For current holders, that means appropriate position sizing, conviction in your long-term thesis, and psychological preparation for extended suppression. For potential investors, it means systematic accumulation, preference for physical holdings, and realistic expectations about timing. For everyone, it means disciplined behavior, emotional control, and intellectual humility. The entities capable of holding 31,828 short contracts have resources and sophistication that retail investors don't possess, but they also have vulnerabilities. They have quarterly reporting requirements, regulatory scrutiny, and the fundamental problem that paper claims ultimately must reconcile with physical reality. Your competitive advantage is patience, lack of career risk, and ability to act on timelines measured in years rather than quarters. Markets reward different participants at different times. In manipulated environments, patient capital with strong hands ultimately prevails. Not because manipulation always fails, but because maintaining suppression requires constant effort and capital, while holding physical assets requires only patience. Build positions appropriate to your situation, maintain discipline through volatility, ignore daily noise, focus on structural drivers. Whether the 31,928 contract position represents manipulation or merely market dysfunction matters less than your response to that reality. Position yourself wisely, behave rationally, think long-term. This is the path to navigating complex, potentially manipulated markets successfully. Thank you for your time and attention today. If you found this analysis valuable, remember that red subscribe button below. We'll continue examining important financial developments with the same measured, thoughtful approach. Until next time, stay disciplined, stay informed, and stay solvent.